All right, welcome back, everybody. It's me, and this is Market Moves, the show where we look at some of the biggest moves in the market today and break them down to see what they mean for you as an investor. We are going to start looking at some stocks that have been mentioned recently on our channel, and then we'll take a look at a couple other stocks that have been performing well recently. We will also be giving away some free stocks at the end of today's video. So make sure you watch all the way through if you want to try to win some free money. Before we get started, please make sure you subscribe so you don't miss out on any of our upcoming videos. If you guys could also do us a favor and give this video a thumbs up, it really helps us out a lot and it helps push us onto the algorithm's good side. Okay, let's jump into the first stock we're talking about today, and that is Palantir Technologies. Now, this is a company that I'm sure a lot of you have heard of before. They operate in pretty much every aspect of the US government, and over the past few years, they've made huge strides into commercial business as well. They're led by one of my favorite CEOs, Alex Karp. He's very intelligent, and he does a great job at keeping his eye on the ball when it comes to the vision of the company and not being distracted by short-term noise. When I look at Palantir, I see a company that is absolutely killing it. In the last quarter, they beat earnings estimates by a whopping 26 cents. They also beat revenue estimates by nearly $1 billion, and in a market like this, that is no easy feat. Their revenue grew 12% year over year, and their adjusted EPS was actually up 29% year over year. That is impressive growth in a tough environment. The company also just announced that they were expanding their partnership with the United States military and are going to be providing services in over 40 different areas. One of the most interesting things that I see happening with Palantir right now is that the stock has been consolidating for quite some time. If we go back and look at the last 3 months, we can see that the stock price has essentially been trading between $16 and $20 per share. This type of consolidation is normally a sign that the market is waiting for some sort of catalyst to push the stock price higher. In my opinion, that catalyst could come in the form of the recent partnership expansion that we talked about earlier. It could also come in the form of some positive news from their commercial business, or it could simply be the fact that the stock has become dirt cheap. When we look at the valuation metrics, we can see that the forward PE ratio is only 18.71. The price-to-sales ratio is at its lowest point since the company went public, and the dividend yield is sitting around 3%. All of these factors combined make me think that the stock price could be due for a move higher in the near future. Now, obviously, this is just my opinion, and this is not financial advice, but these are the thoughts that I have on Palantir and why I think it is worth keeping an eye on. Next up, we have Shopify, which reported quarterly results that surpassed both earnings and revenue expectations. In fact, revenue was 13% higher than last year, even though the company saw a 24% drop in GMV, or gross merchandise volume. This tells me that Shopify is becoming more and more of a staple in the e-commerce industry, and businesses are choosing to stay on the platform even when times are tough. Another positive sign for Shopify is that they are continuing to invest in growth even though the economy is slowing down. In their last earnings call, CEO Harley Finkelstein said, quote, "We are seeing significant momentum across new and existing merchants and are well positioned to continue to grow market share in the near term." I think this is a smart move because if Shopify can gain market share while other companies are pulling back, it will only help them grow faster once the economy starts improving. The stock has already reacted positively to the earnings report and is up around 10% in the past 2 days, but I still think there is potential for growth here. The stock is still down more than 50% from its all-time high, and the forward PE ratio is below 20. I think Shopify is a great long-term investment and a stock that I would recommend buying and holding for at least 5 years. Moving on to Tesla, which has been making headlines recently for a number of reasons. The first reason is that the company was just named the world's most valuable car company, topping even Toyota at nearly $600 billion. This is a huge accomplishment for Tesla, and it shows that the market is finally starting to take them seriously as a competitor in the auto industry. The second reason that Tesla has been in the headlines recently is because Elon Musk sold another $934 million worth of stock in the past week. This brings the total amount of stock that he has sold over the past 3 months to nearly $4 billion. I know this is probably concerning to a lot of investors, but I want you to remember a couple things. First, Elon still owns 22% of the company, so he isn't going anywhere. Second, he has said that he will not sell any more stock until the share price is below $320. And third, he has been selling stock to pay taxes on stock that he previously owned. So overall, I wouldn't worry too much about the stock sales. As long as he doesn't sell more than 10% of his stake in the company in any given quarter, he is required to tell the SEC how much he is selling and why he is selling it. But if he buys or sells less than that, he doesn't have to publicly disclose his trades. So if you've seen a trade that has not been disclosed, it was most likely part of a hedging strategy. Elon has openly said that he uses options to hedge against risk, and it is not uncommon for him to buy and sell stock throughout the day as part of a hedging strategy. Lastly, Tesla has been awarded a huge contract from the U.S. government to provide electric vehicles to the federal government fleet. The company will supply 100,000 cars over the next 6 years, and this deal has the potential to be worth billions of dollars. This is a big win for Tesla, and it shows that electric vehicles are quickly becoming mainstream. The company is clearly the leader in the EV space, and I think there is still a lot of room for growth here. Last but certainly not least, I want to talk about Broadcom, which is a company that makes semiconductors and software for data centers, smartphones, laptops, and more. The company recently raised its dividend by 20%, which was their 17th consecutive year of increasing the dividend. This is a great sign that the company is financially healthy and they have a lot of confidence in their future growth prospects. In fact, management just raised their guidance for the year and now expects revenue to grow 11% and earnings to grow 17%. The stock currently has a dividend yield of around 3.4%, which is higher than the S&P 500 average of 2.9%. So this is an added bonus for investors who like to focus on dividend growth. The stock is also down around 15% from its all-time high, and the forward PE ratio is at its lowest point since 2019. So I think the stock could have some upside potential in the near future. So that wraps up the stocks that we're looking at today. Don't forget we have some free stocks to give away at the end of the video. Make sure you watch all the way through to find out how to enter. Now we're going to look at some important economic data that was released today, and then we're going to look at some other investments that might be worth considering. All right, so the most important piece of data that was released today was the October jobs report. The headline number came in at 271,000 new jobs added, which was slightly lower than estimates of 280,000, but it was still a very strong number. The unemployment rate also ticked down to 3.7%, which was in line with estimates, and the participation rate ticked up to 62.3%, which is a positive sign. Wages also increased 5.7% year over year, which is a slight cooling from last month, but still a very strong number. Overall, I think this jobs report was pretty decent, and it doesn't change my outlook for the economy. There is still a lot of slack in the labor market, and wage growth is still very strong, which is helping to support consumer spending. The next piece of data that we're going to look at is the ISM Manufacturing PMI. This index measures the health of the manufacturing sector in the US, and it's one of the leading indicators of economic activity. The October reading came in at 50.2%, which was lower than estimates of 51%, and the September number was revised down to 50.4%. Any reading above 50% indicates expansion in the sector, and anything below 50% indicates contraction. So this is technically speaking a contraction in the manufacturing sector, but honestly, this report doesn't really concern me. The manufacturing sector only makes up a small portion of the US economy, and this is just 1 month of data. I would need to see a few more months of contraction before I started getting worried. Next up, we have the Market Manufacturing PMI, which is basically the same thing as the ISM Manufacturing PMI, but this one is more focused on small businesses. This index also came in below 50% at 49.6%, which was lower than estimates of 50% and lower than the September reading of 50.7%. Again, any reading below 50% indicates contraction in the sector, but I don't think this is anything to be concerned about just yet. Finally, we have the FOMC meeting minutes, which were released today, and they gave us some insight into what the Fed is thinking about monetary policy. The main takeaway from these minutes is that the Fed is still committed to fighting inflation, and they are willing to slow down the economy if necessary. However, they are also open to pivoting if inflation starts to come down faster than expected. The minutes said that participants discussed the possibility of slowing the pace of increase at some point in coming months if the, quote, timely removal of accommodation could leave the economy well positioned to achieve maximum employment and inflation at the committee's longer-run goals. This basically means that the Fed is open to slowing down rate hikes if inflation starts to come down faster than expected and they feel like they can get to their goals without causing a recession. All right, now we're going to look at some investments that you might want to keep on your radar in 2023. The first investment I want to mention is the Vanguard S&P 500 ETF, ticker symbol VOO. This ETF gives you exposure to the S&P 500 index, and it is one of the most popular ETFs in the world. The fund has a very low expense ratio of 0.03%, and it has a long history of solid performance. Next up, we have the Schwab U.S. Aggregate Bond Index Fund, ticker symbol SCHZ. This ETF gives you exposure to a variety of U.S. bonds, and it is a great option for investors who are looking for some stability in their portfolio. The fund has an expense ratio of 0.03%, and it has a track record of withstanding market volatility. All right, now we're ready to give away some free stocks. If you enjoyed this video, please make sure you subscribe so you don't miss out on any of our upcoming videos. Also, if you want to learn more about stock market investing, check out our website for more resources.